Thursday, July 29th, 2021, Maneco 64, home of alternative economics and contrarian views. So today we're going to look at how there's no end in sight to the inflation. The Federal Reserve is not concerned about the dollar's purchasing power. And before I start, though, I like to make a couple of corrections. First of all, the COMEX came out and corrected the data that I talked about yesterday about the fact that their eligible silver stocks went through the roof by more than 1.24 billion ounces. They came out and said it was a mistake. Think what you want about that. The LBMA made a mistake of 106 million ounces a few months ago. They corrected that. You kind of wonder if it's incompetence or shenanigans. I don't know. Are they employing back office people in the third world? People probably who can't even read English properly and they typed in the wrong number. Who knows? But anyway, I'd like to apologize. I guess the lesson to be learned about this mistake by COMEX and my correction is that you can't really trust COMEX data or LBMA data. And that's why the precious metals market are, in my opinion, a place to be, because it's a house of cards, not gold and silver itself, but the paper market. And that will eventually translate into a price discovery that is going to shock people, a price discovery for real physical gold and silver. What's the other correction? I like to start with my background, because some of you are new to the channel. Some of you have asked me, what's your background? I'll be very brief, just my professional background. I started out at a small private bank. They called it fiduciary back in Geneva, Switzerland in the late 80s. I worked there for 2.5 years. Then I moved to London and I worked basically as a futures and options broker for 20 years. And I covered the government bond markets for institutional clients. So that's my background. But anyway, the Federal Reserve had its meeting yesterday. I said that they weren't going to have a press conference, but they did. And the thing is that the Fed used to have a press conference every other meeting, but now they have it every meeting. What they don't have every meeting at the moment is their projections for the economy and rates and things like that. But I can tell you that 20, 25 years ago, or even 30 years ago, Fed decisions weren't that important. There were no press conferences. So I expect actually the harder it gets for the Federal Reserve to keep this Ponzi scheme going, they might even have weekly press conferences, not just at every meeting. Because someone said, I don't know who it was, sorry, I can't give you credit, that the Federal Reserve now is just a public relations organization. I think it was John Titus of Best Evidence. But anyway, back to the subject here of inflating. Yes, the thing we need to understand, and hopefully most of you who have been following me for a while know, that inflation is the creation of money and credit out of thin air. It's monetary accommodation by the central bank. Unfortunately, we have a central bank. In a perfect world, monetary policy is set by the market, but in this world, it's by the central bank. And it used to be that the central bank used to do maybe a better job than they do now, even though I'm reluctant to say that. But there was a Fed chairman, I think his name was William McKesney Martin, or Bill Martin from the 50s or 60s. He said that the job of the Fed was to take away the punch bowl when everything got too frothy. Well, I don't think Jay Powell has ever heard of the punch bowl analogy, because he's he's at the Delta Delta fraternity, Delta 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 fraternity, filling the punch bowl, and there's no end in sight. He's the junkie that is saying, I will decrease the doses of my hits, but please wait until the end of next year, maybe 2023. I still need my hit. That's what Jay Powell is. That's what the financial markets are. That's what the economy is, unfortunately. And that's why you need to try to get away from this kind of economy. And how do you do that? Well, you stay out of their system as much as possible. You don't borrow. You try to borrow as little as possible. Live within your means. Saving real money, i.e. gold and silver. And by the way, I'm going up to Gold Investments today to pick up some of the things that you sent to me there. Oliver said you've sent me some more stuff. And for the new viewers who are in Europe and the UK, if you're thinking about buying precious metals, gold and silver, talk to Oliver Temple at Gold Investments. He's very helpful. Go to their website as well if you don't need help, goldinvestments.co.uk. The details are all below in the description, and you can quote promo code Monaco64 and you get a slight discount when you buy gold and silver through them. But anyway, yeah, I'm going up there this morning. I'm going to take the train into the city of London, into the den of vipers. Yes, Gold Investments, they've been around for almost 40 years. It's a family-run business, arguably one of the oldest bullion dealers in the city of London. So, yes, I'm going to play you a clip now. It's about 2 minutes long. It will just give you an idea of what Jay Powell thinks about inflation. It'll give you an idea of how clueless he is about what inflation really is. So here it is.
The concept of transitory is really this. It is that the increases will happen. We're not saying they will reverse. That's not what transitory means. It means that the increases in prices will happen. So there will be inflation, but that the process of inflation will stop, so that there won't be further. When we think of inflation, we really think of inflation going up year upon year upon year upon year. That's inflation. When you have inflation for 12 months or whatever it may be, I'm just taking an example and not making an estimate, then you have a price increase, but you don't have an inflation process. And so part of that just is that if it doesn't affect longer-term inflation expectations, then it's very likely not to affect the process of inflation going forward. So what I mean by transitory is just something that doesn't leave a permanent mark on the inflation process. Again, I don't mean that producers are going to take those price increases back. That's not the idea. It's just that they won't go on indefinitely. So to the extent people are implementing price increases because raw materials are going up or labor costs or something's going up, the question really for inflation really is, does that mean they're going to go up the next year by the same amount? So you're going to be in a process where the inflation process gets going, and that happens because people's expectations about future inflation move up, and we don't think that's happening. There's no evidence that it's happening. All the evidence is that it's not happening. But nonetheless, we have to watch this very carefully, because this is, we have two mandates: maximum employment and price stability. Price stability for us means inflation averaging 2% over time, and so we've got to be very careful about that. But I think it's a good point that it's a term. What it really means is temporary. But then you got to understand that it doesn't mean that the increases will be taken back. Some of them will be, but that's not really what it means.
So there you go. The guy's all over the place. doesn't seem to know what inflation is. One thing's for sure, he's going to keep inflating. So why do I say that? Well, the first thing is you need to look at the data and not what these people say. Look at what's really happening. And as you can see here, the Fed's balance sheet, which is a big signal of how much they're inflating, it's continuing to move higher. It looks like it's accelerating. It's at a record. Back in September of 2019, when this crisis really kicked off, and it was before the health crisis, it was the repo crisis, which is still around, and I'll come to that in a minute. That balance sheet was at 3.7 trillion. They were trying to unwind the balance sheet at the time, and they couldn't, and they can't taper anytime soon. Of course. So we've gone from 3.7 trillion. We've more than doubled. Now we're at 8.2 trillion. So what did the Fed and Jay Powell say yesterday? Well, immediately after the statements or comments from the FOMC, and that's different from the press conference, that came out at 2 p.m. New York. The markets basically and the mainstream media said the Fed is saying that the economy has made progress, or the FOMC, and that their goals towards tapering are coming closer, but they don't tell you when. And we also found out that the Fed, or the FOMC, is launching a new program for the repo market. And the Federal Reserve, the central bank, is not supposed to be involved in the repo market. It's supposed to be a market amongst primary dealers, financial institutions, and all the like. So it just goes to show that there's a problem there. This is an emergency. Not only have they launched a program for domestic institutions on Wall Street, but also for foreign institutions, foreign financial institutions, and central banks. And they've given them a line of credit, the foreign institutions, not in total, but per institution, of $60 billion. For the American financial institutions, they've given them a line of credit of $500 billion. So that's an emergency, people. The repo market was not a place where the Fed used to be involved up until September 2019. So the repo getting continues. So we are under an emergency. And what do they do under an emergency? What's the only thing they know how to do that's going to lead to the debasement of the currency? Well, it's to create more and more inflation, fiat currency and credit out of thin air. That's going to dilute the purchasing power of existing currency. It's just like as if a big corporation, or any corporation, kept doing rights issues every month, and that's what the Fed's doing. What's a rights issue is when they issue new stock. Everyone that already owns that stock, their shares are going to be diluted. So that's what the Fed's doing. The Fed is going to keep inflating, and they can't stop it because, unfortunately, for the last 20 years, whenever there's a crisis, the Federal Reserve and other central banks, they don't want to let it play out, and the crises are getting bigger and bigger. The response to these crises are getting bigger and bigger, and because they can't stop. So it's going to end in tears, either through a hyperinflationary collapse, or maybe even a collapse, maybe a deflationary collapse, or an asset price collapse. Who knows? I think the big takeaway is that one needs to have hard assets. Continue to have hard assets. Yes, of course, they're not going to go up in a straight line, but they're going to be a safe place. And why hard assets? Well, because they can't be created out of thin air. It's very simple. It's because they're real things. And in a world where reality is completely inexistent in these financial and monetary markets, we need to have hard assets as protection, I would say. So as you see here, stocks blast off once Powell defines substantial further progress as just jobs, not inflation. So he's not concerned about inflation. And you listened to him earlier, that clip that I played you. So yes, it's not going to stop the inflation. As I said, the Fed's like a junkie saying that they're going to cut down on their intake of narcotics, but it's only going to be in a couple of years' time, maybe even further out. And of course, they have the scapegoat that we all know what it is if you listen to my channel. It's to do with the current crisis, right? It's evolving into derivatives. And what do I mean by derivatives? Well, they're not the financial kind, but these guys like derivatives, don't they? It's called a variant. So there we go. With that, let's look at where these markets are this morning. It's 8:24 a.m. London time. So we've got spot gold actually up about $12 at 18.77. So gold is doing fairly well. So the high overnight has been 18.20, the low 18.0580. Silver is up 43 cents, just under 2%. So silver is outperforming, but we still have a long day ahead of us, of course. Right now we're at 25.40. The high's been 25.42, and the low has been 24.92. The Dow futures up 108. The NASDAQ futures up 8.5 points. S&P is up just under 8 points. The FTSE is up 29 points, just above 7,000. The pound is up 1/3%, 139.50. So currencies continue to move higher. The dollar is taking a hit right now. As I've said, though, all fiat currencies are going to sink versus real money, gold and silver. Yes, you could be overweight euros and pounds versus the dollar, and you could do well there right now. So the euro is up 0.2% at 118.68. The dollar is down slightly versus the yen at 109.81. And the dollar has dropped relatively sharply versus the yuan in the last few days. We had gotten back up to around 652. So that's how many yuan you can buy with a dollar, 652. But now we're at 646.50. So the dollar has come off in the last few days. Overnight is down 1/3%. The Aussie dollar this morning is up 1/4%, almost up to 74. And the dollar is down 0.4% versus the Canadian dollar at 124.74. So a quick look at the general commodities here. WTI crude seems to be picking back up. We tested that 70 level. Actually, we went below it. We've come back up. We're at 72.82 right now, up almost 1%. High-grade copper up 0.5%, just below 450. To finish off, let's look at the Treasury or bond market. The 10-year yield is up slightly from yesterday when I spoke. It's up about 1 basis point. It's around 125. It's down about 2 basis points overnight. How come bond yields or treasury yields are so low considering that there's so much inflation out there? Well, there's a couple of things. First, the Fed is creating more and more inflation in order to manipulate this market to trick investors into thinking that the prospects going forward in the future are that inflation is going to come under control. And they're doing that by creating more inflation. And what do I mean by that? Well, they print more money to buy these bonds to keep the yields down, because in bonds, when you buy the bonds, you drive the prices higher and yields go inversely lower. The other thing is that I guess people still trust the Fed. A lot of people. I think that number's getting smaller and smaller, though. So we need to also realize that even if bond prices stay stable or go up a little bit, if the dollar is dropping faster than bond prices, is it really worth having these bonds? Especially if you get very little in terms of a coupon or an income from them. I don't think so. So that's it for today. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.